Sometimes it feels like the stock market isn't a serious financial system at all, but a full-blown reality show. Think about it. People sitting at home, chilling, numbers moving up and down on a screen, and every minute someone yelling, "Bro, this is the dip, load up." And if the price goes down, it's manipulation. If it goes up, see, I told you so. Welcome to modern investing, where analysis is optional and confidence is mandatory. What used to happen before? Let's take a quick flashback. Back in the day, investing was boring. People looked at balance sheets, read earnings reports, and tried to understand what cash flow actually meant. Basically, finance in its purest form, where excitement equals 7% annual returns, risk is the company is growing a little slowly, and fun is discovering a new Excel formula. Today? Today, investing is something people do before getting out of bed. Alarm rings, phone picked up, market opened, portfolio read, day ruined. 2020, when the market drank Red Bull. Then 2020 arrived. Pandemic, lockdowns, free time, stimulus checks, and interest rates that literally fell underground. Suddenly, everyone became an investor. People who had never even opened a fixed deposit were trading options, and 19-year-old financial gurus started popping up on YouTube. It was like the market chugged a Red Bull. Everything became a rocket. Losses? What are those? Even if a stock fell, there was only one response: buy the dip. Not a dip, even if it was a crater, still buy the dip. Stocks only go up? Famous last words. This phrase got repeated so many times that people started treating it like a rule, as if gravity is optional, valuation is just a suggestion, and risk management is only for textbooks. The market trained people to think a drop equals opportunity, panic equals entry point, and doubt equals boomer mindset. If someone says, "Isn't the valuation a little too high?" the reaction is, You don't get it. It's a new era. Yeah, that's said during every bubble. Fundamentals reduced to a side character. Fundamentals used to be the hero. Now they're the side character who appears in one scene. People don't ask anymore, how much does the company earn? They ask, is this stock hyped? They don't ask, how much debt does it have? They ask, is it trending on Twitter? They don't ask, is the business sustainable? They ask, what are Reddit people saying? The market no longer runs on valuation. It runs on vibes. Michael Burry and an existential crisis. And when markets start running on vibes, it becomes a problem for people who trust numbers. Investors like Michael Burry, the same guy who spotted the flaws in the system in 2008, now look confused. Imagine this. You spend your entire life studying math, and suddenly the exam question is, how do you feel about it? The market replaced experience with a cheat code. So what are prices actually driven by? Simple answer: people. The market isn't some alien AI. The market is us, our greed, our fear, our FOMO, and our group chats. Behavioral finance says people fear losses more than they value gains. People follow the crowd. People react more to stories than to facts. Before, all this happened slowly. Now it's real time. One tweet, a pump. One rumor, a crash. One meme, a $1 trillion valuation. Social media, the market's secret spice. Information used to spread over weeks. Now it goes viral in seconds. And when the gap between reaction and action goes to zero, the market stops moving on logic and starts moving on emotion. You've probably noticed, news comes out, price moves first, explanation comes later. The market decides first, then looks for a reason. Institutions adapted too. This isn't just a retail thing. Big funds now track sentiment, measure attention, analyze narratives. Because in the short term, these things work better than DCF models built on 50 assumptions. The market no longer prices cash flows, it prices clicks. So is this a bubble or a new era? Now, the real question. Option 1. This is temporary. History will repeat itself, the bubble will burst, gravity will return, and fundamentals will become the boss again. Option 2. This is a permanent shift. Friction is gone, participation has never been this high, and attention has become a new asset class. The truth? Probably a bit of both. The final twist. Maybe the market feels weird because we've become weird too. We want things fast, we want excitement, we don't want boring answers. And the market just started reflecting our personality. So when we ask, why is the market so irrational? The answer might be, because we are. And maybe the funniest part of all is this. Debating whether we're in a bubble might itself be part of the same bubble.